Hello, fellow traders. 'Tis I, the Rumpled One. Thinking fast and slow. I'd like to share a few readings from this book. Because as traders, we definitely need to think fast sometimes. But do we? And actually, if you have to even question, why are you a trader in the first place? Based on statistics, you're going to fail. 90% of traders fail. I mean, most money managers, people who are paid to manage money, can't beat the market. So what makes you think you can beat the market? Got some method that you learned, maybe you invented, maybe you paid hundreds of $1,000s for some course that tells you about things like supply and demand, support and resistance, trend. You bought some hot EA that, produced 1,000 pips last month. Are those the results you're getting? No. We know there's not. But you persist, don't you? Well, there may be a reason why you persist. Why you think you can beat it. But the question is that reason grounded in reality, in statistics? Or is it just some belief that you think you can beat the market? Let me read from page 204. The illusion that one has understood the past feeds the further illusion that one can predict and control the future. So because you see this one pattern on the chart from the past, you think maybe you can predict what's going to happen next on the chart? Is that what's going on? How's that working for you, as Dr. Phil would say? Let me go back to page 200. The ultimate test of an explanation is whether it would have made the event predictable in advance. Now, predictable. In other words, you knew it was going to happen. With certainty. Not almost certain, but certainty. In other words, you bet your life on it. I don't think there's anybody out there would bet their life on the next trade. I just don't. Unless they're crazy, right? Do you really think you have some method to predict how the market's going to move that you would risk your life on it? No. But you're risking your money, your financial life. You might want to consider that. And you're probably asking yourself, but Rumpled One, TRO, you put these methods out there and you've been around for years. So why are you doing it? Well, the answer is because I base my trades on reality and not concepts. That's why. Because as the book explains, you see, the past, you really can't explain the future from the past. Not in trading, because it's unpredictable. Really is. Let me read from page 207. The comparison of firms that have been more or less successful is to a significant extent a comparison between firms that have been more or less lucky. Knowing the importance of luck, you should be particularly suspicious when highly consistent patterns emerge from the comparison of successful and less successful firms. In the presence of randomness, regular patterns can only be mirages. Now think about that as traders. Let me reread it, but I'll substitute a few words. The comparison of traders that have been more or less successful is to a significant extent a comparison between traders that have been more or less lucky. It's that simple. Now once again, my systems, how I do things, the outcomes don't depend on, market. Is it a trending market? Is it a congested market? Is it a ranging market? No. There's certain things that just pretty much have to happen. We know price goes up and down. Price very rarely stays the same. Not in the volatile stocks and currencies that I like to trade. But you see, the difference is that I developed a tool, but then I didn't stop there. I found out what stocks and currencies work best with that tool. So I wouldn't trade a stock that doesn't work well with the tool. Why would I? There's no money in it. Not to mention, I advocate possibly trading the same stock over and over, day after day, for weeks, months, years, until the statistics change on that stock. For those of you who are familiar with me, know I like to milk the cows. There's certain stocks that come out as cows. Now, RIM, R-I-M-M, used to be a cow. RIM's no longer a cow. I no longer trade RIM. Apple, still a cow. It's an expensive cow now, but it's still a cow. Don't trade it as much. But my point is that, see, these things, whether or not I win, that's based on luck. But the thing is that every day, those stocks go up and down. They have to leave the buy zone. They have to. My little system called the buy zone, where for stocks at the open, plus or minus 10 or 20 cents, that's the buy zone. I'm sorry, plus 10 or 20 cents is the buy zone, minus 10 or 20 cents is the sell or short zone. And these stocks that have an average daily range of $1 or more, they have to go through those zones, otherwise they can't hit that range. So you see, it's not based on some squiggly line indicator. It's just based on measurements, pure statistics. The stats run every day. They get emailed to my inbox, and I can see, are these cows still cows or something changed? 80% of the time or more, they cut through that buy zone. Usually both sides. But that's how I trade stocks. Same thing's true with currencies. They'll cut through the buy zone, the sell short zone. They have to. They have to range. So it's not based on any concept. It's based on pure math. You can't fit a ruler in a 12-inch ruler in a 4-inch box. It's going to stick out one side, the other, or both. I've done a video on that to show you. So what I do stands up to what he's talking about. But of course there are those who are going to say I'm wrong, but that's okay. I'm playing my game and you're welcome to play yours. Page 224. Why are experts inferior to algorithms? One reason which Mill suspected is that experts try to be clever, think outside the box, and consider complex combinations of features in making their predictions. Complexity may work in the odd case, but more often than not it reduces validity. Simple combinations of features are better. Once again, my buy zone's simple. It's a few horizontal lines. Don't need any other indicators, just a few horizontal lines. But you see, many people are vested in expensive trading programs and indicators and methods and books and courses and boot camps where they can't have some guy who has a couple horizontal lines go out there and tell you can trade and that's all you need, that would just disrupt the entire traditional trading education industry. It's that simple. They don't want you to know this. But as this book says, and by the way, this guy won a Nobel Prize in economics, so I think he might know a little bit about what he's talking about, is that these experts are inferior to algorithms. You see, I ran statistics, and that's the way I trade, based on those statistics. It's not some complex algorithm. It's not some formula that you can't understand. But stochastics, can you explain how that's calculated? How about MACD? Most traders can't, but they use them. Why? Doesn't make any sense to me. And let me continue. Several studies have shown that human decision makers are inferior to a prediction formula even when they are given the score suggested by the formula. They feel that they can overrule the formula because they have additional information about the case, but they are wrong more often than not. So you see, that's why when you have something simple, you just stick to it. I mean, fading the gap. How simple is that? If today's open is below the previous close, as soon as you see some movement toward the previous close, you go long. If today's open is above the previous close, and you see some movement towards the previous close, you go short. You combine that with those cows in the buy zone, you've got a system that's going to pay out almost every day. It's not going to do it every day, but it's going to do it more often than not. It's just up to you to take advantage of it. And then there's people who talk about the stops and the whipsaws, but you know what? That's part of trading. You're not going to win every trade. You just need to win more than you lose, more money than you lose, not necessarily more trades. It's that simple. And you have to know when to quit. If you just made a couple $100 in 30 minutes or less, why are you still trading? How much is enough? That's for you to decide, not me. But you need to question your motives, question your ego. Do you just want to be able to brag that you made 10,000 or something today or this week? That's not a real trader. Now let me continue. According to Mail, there are a few circumstances under which it is a good idea to substitute judgment for a formula. In a famous thought experiment, he described a formula that predicts whether a particular person will go to the movies tonight and noted that it is proper to disregard the formula if information is received that the individual broke a leg today. The name broken leg rule is stuck. The point, of course, is that broken legs are very rare as well as decisive. So you see, there's a lot to be learned from this book, Thinking Fast and Slow. I suggest you read it and think about it before you trade and think about it while you're trading. Because you want to see if possibly you're making some of these errors in judgment, or you're basing your financial venture in trading on some formula that statistically isn't a winner. Now, people always love these back tests, and no, because it could change. But things like my buy zone, it's not going to change. Now, the stocks you trade with it may change, but the buy zone, it's a fixed criteria. Those lines are the same every day. The blue lines, open plus 10, open plus 20. The red lines, open minus 10, open minus 20. Every day they are the same. You have the open line and you have the previous close line. You want to trade towards the previous close. The open's above the previous close. you trade down. If the open's below the previous close, you trade up. It's that simple, fellow traders. It's that simple. And remember, it's not what you trade, it's how you trade it.